All right. Hi, everyone. Welcome to the TimingResearch.com crowd forecast news for August 26th, 2024. We are recording this at 1 p.m. Eastern Time, and this is episode number 444. My name is David Cosmeter. I'm the creator of TimingResearch.com, and today is actually a special 10th anniversary episode. So yeah, as of 10 years ago yesterday was the very first episode of this show, and so today I have arranged for Doc Severson to join us, who was on that first episode. So happy to have him here. And Michael Filighera was also here, who was on, what was it, the second or third episode, I think? Yeah.
Second.
And also Hans Albrecht, who is more of a newer member of the Timing Research family. And then, of course, the options professor, who is here to moderate again. So I'm going to go ahead and turn it over to the option professor.
Okay, great. Okay, guys, good to be here on this anniversary day. Let's see if we can get some anniversary good ideas going here. With regards to the markets right now, we're going to start out with that S&P. And the S&P had a big week last week, particularly to close out the week. And so what we're going to do is we're going to discuss whether that was what they call a stampede into a dark hole, or is it a pause to refresh here today, or what's going on? So let's start with Michael Filighera. Mike, what are you thinking of where we are right now? 56.43 on the future, I guess, something like that.
What I'm actually thinking is that it could be exactly what we were saying earlier. It could be a tip over into a little bit larger bit of a correction. I think the way that I'm viewing this right now, there's a very strong possibility that we go back down and retest the August 4th, 5th lows, and then rally one more time back up to new all-time highs. Or we actually just do a smaller type of a correction right now, which would likely keep us above 5,600. And then turn and rally up to new all-time highs. So I think right now we're just basically consolidating and tipping the scales. I don't know if it's being done on purpose or whatever, just to kind of see what forces it in. I know I've got other levels that where and this might be something that Hans could also talk with. It would have to do with gamma levels and the gamma flows. And so far in the S&P, I've seen that they've kind of broken some of the upper levels, brought it down to a support level, but now they're taking it back up to either get it back above that level or to just pick up the rally again. So
that's pretty much what you're saying.
Yeah, actually it is. I think on a longer term picture, I do think that we do go up and make, again, new all-time highs, but that's going to provide a stronger reversal point and another strong downside move.
Okay. And Doc, how are you feeling about the S&P right now?
Hey, Jim, a long time no
Hi.
talk.
Sure.
Yeah, hey. So what I'm looking at right now is, if you notice, we actually went up a lot faster than we went down into early August. And so to me, that shows a little bit of commitment, and that shows a lot of people. I think there was a lot of delta hedging that caused that. To me, I think that we're following the 2007 analog pretty faithfully. We had about the same kind of thing going on into the Fed pivot. And so I think we'll probably hit new highs here before too long. And that happens either whether we do a high and tight consolidation, which is what we're doing right now. We might also get what I call a scary higher low. So we see an S&P day which drops 50 points, and it may be on something like NVIDIA earnings on Wednesday, or it could be the PCE showing a slight bit of uncertainty on Friday. And that maybe drops us down to as far as 5,500, but I think that's going to be it as far as the damage. And I think that'll slingshot into higher highs from there. But as we get into the fourth quarter, I think this is where We got to pull everybody along. We got to convince everybody that markets are headed much, much, much higher before we go down. I don't think we go down from here. That's my room temperature IQ viewpoint at this point.
I was also wondering, like, we're at 56. Where are you at right now on this thing? About 56? I can't
Well,
really see the price.
Cash index 56.26.
Okay, so there's about a almost a $20 difference between futures and cash, and so we're going to be having to get rid of that, aren't we? You know, because this thing doesn't it mature up here in the next few weeks?
By September, yeah.
Yeah, well, September is next week.
Well,
And
yeah,
so there's a little bit of a premium there.
Yeah, September expiration, the cost to carry goes away.
That's what I was thinking. So, you know, that's another factor to come in, because I was looking at the future. The September all-time high is like 57.21. And I know that the SPX, I think, is around 56.70.
Yeah,
so
bingo.
there's you know, there's always that differential, because contango's got to go away as it comes to maturity. So anyway, yeah, you're still like that 2007 thing you mentioned, wasn't it kind of a deal where, you know, after their first hike, maybe 3.5 weeks or so, the market continues to do pretty good, and then it rolls over like a lawn chair at that point or something like that?
Yeah, it's almost exactly the same timing, Jim, because what happened was the market was selling off the first 10% correction that we'd had in several years.
Yeah.
And so the Fed got together with an emergency meeting, and they said, yeah, we're going to be probably cutting rates at our next meeting, which was coincidentally mid-September in 2007. So like you said, we actually got a big 50-point handle to the upside on that day when the certainty came back into the market. And I think we got about 3 weeks after that, the market topped out around October 7th, something like that. So we got 3 weeks of coasting to the upside, and then the trouble started.
Yeah, pretty borrowed time. The other thing is, you know, the Fed cutting you think it's going to be like a binary event, meaning it's either going to be established that they're way late, or they have no business cutting. You know, I'm trying to say, I mean, how do you feel about the cutting, Doc, as far as, you know, could it be a binary effect of, like I say, something's going to come out to make it, like I have 800,000 jobs that never were existed. It's certainly a big number. So, I mean, from a labor point, you know, instead of like 3 million jobs, you only created 2 million. That seems like a big differential.
Most of the time over the past 30 years, every time the Fed has eased, we have trouble in paradise not long after that.
Yeah. Hans, what are you thinking about the S&P?
Yeah, I think it was Doc who sort of said, you know, are people going to be compelled to buy stocks? And I feel like that's sort of where we're at, where nobody really wants to buy stocks. But you've got these sort of two camps here, one where you know, a lot of folks kind of feel that, okay, the Fed's starting to cut rates. That's historically, that's not a great thing. But at the same time, they're worried about missing out on the upside. And I don't think FOMO has gone away at all. I think the recent bounce is pretty good evidence of that, you know, FOMO is here to stay, at least for some time. And I mean, I think the trader in me, I've gotten a little more bullish over the last few years. Maybe as I get older, I start to I'm kind of, you know, kind of quieting down a little bit. Yeah, I'm slowing down a little bit. I can't handle all this bearish all the time. But so I try to lean a little bit more bullish, which is really probably in reality the way to be, considering charts have gone from the bottom left to the top right over the last 100 years. It's probably the better way to be. Yeah. And so, you know, I'm looking at flows. I'm looking at flows a lot. Because that's what really matters in the end. My opinion, you know, there's the old saying that bears sound smart, bulls make money. And so I'd like to question everything I hear. So if the narrative is, well, you know, and this is a big one, rates are coming down. So that's true. That's historically a bad thing. But is it? If rates are coming down because real rates are too high, then that's a little bit different. I don't think we can compare that to some of and I hate to say this time's different, right? That's probably what you're going to read between my lines here, is this time it's different. But the fact is, if inflation is somewhat under control, and that's debatable, right? We all go to the grocery store and buy insurance and things like that. So, but whatever. Okay, the Fed says it's 3%. Great. So if inflation's under control and rates are high, generally speaking, real rates are very high. So can you not bring down rates in order to compress that sort of premium there, and really have a kind of, kind of Goldilocks scenario where the porridge is warm and you got rates coming down, you've got growth pretty good. I mean, all this I've been saying for a month now, that this unemployment worry, this economic worry has been just a crock of crap. Like, there is so much good data out there. Look at the recent small business confidence. It's soaring. That doesn't look like a recession's around the corner. And that's
No.
a huge chunk of the economy out there. So there's a lot of, I mean, hotel reservations, travel, you name it, data points across the board are still very, very positive. So I don't like to pee into the wind too much if I don't have to.
No.
And I'm feeling like, maybe things aren't too bad, and we can get this sort of almost roaring 20s scenario where the rest of the market, as we've seen the RSI and things broadening out very, very nicely. I'm not calling tech out because it's still very important to the broader economy, but maybe we have an instance where everything can kind of move at once here. And add to that the CTA flows that are still very positive. These vol targeting funds, we talked about Gamma a little bit earlier, option professor Gamma a little bit earlier. The Gamma is still very supportive. CTA flows are supportive. The corporate buyback windows open. I'm not worried too much.
Yeah. And the other thing is the Fed has a history of going 100 miles an hour in whatever direction they're going. It started out with zero interest, and 100 miles an hour for 10 years, they left it there. And then we had the crisis, and they took the balance sheet from 4 trillion to 9 trillion. And then they wanted to take the rates up, so they took it from 0 to like 5.5%. And so it's somewhat logical to think that if anything happens, these guys would print money and they would drop the rates down to 2%, and they do anything they could to keep the game going. So with that kind of backstop, I think people, as long as the VIX stays under 20, I think big money feels comfortable about putting it in, because they definitely feel like this guy Powell will just totally helicopter money anywhere he can to make sure that employment rate doesn't get into the fives, or barely does. And so I think, this Federal Reserve is a very aggressive whenever they make a move, as far as I can see. So
He
to
just
think that
said
they
that.
could take
Yeah.
they could take the rates down to 2% in 2 months, or 5 or 3 months, the way they did hiking them.
He just said
Yeah.
that, didn't he? He just said that last week. He said, "Look, we're
Yeah.
not gonna tolerate higher
Yeah.
unemployment." I mean, he's putting the Fed put right back in there. He's saying inflation's under control, and we're gonna keep a close eye on unemployment. So he's telling you
Yeah.
there's a Fed put.
Yeah, totally. And then the other thing is he's very well aware that 70% of the economy is the consumer spending. So if they start losing their job and they stop spending, this debt pyramid we've got between individuals, credit cards, and everything else, and then the housing. I mean, the houses have gone up 40%. I mean, if they had a 30% drop in housing because everything slowed down, you'd be back to 2008 maybe with some of this stuff. Who knows? So they don't want this thing deflating that much, and that's why the dollar is going into the toilet as well. Well, let's look at the tech sector, like the SMH, and see if I mean, is there a rotation out of? It seems like there's a rotation out of tech a little bit into this small cap theme, and into maybe these dividend payers again, healthcare, blah blah blah. Let's see if we can put up some charts that might indicate if that's happening or not. This is the semiconductor now. And I mean, has this thing lost its legs a little bit? Let's go over to Michael.
I would say yes, but I don't view the market in the same fashion as you guys. I do pay a lot of attention to gamma flow. I pay attention to capital flows. I pay attention to option flows. And I think that is what is ruling the day. And I think when we go through a period like we just did of risk on trades, it was due to, the whole narrative shifted from a negative gamma, which we had leading up to the lows that we saw, in a couple weeks ago. And so what we're getting is just another strong lift off out of all of that, which again took us all the way up. And that is just a reversal, taking it from very quickly from a negative gamma atmosphere to a positive gamma atmosphere, which is risk on. And so everyone is piling back in. And you talk about FOMO, which I also agree, it can be in full force. They just going to pile in until the levels are broken, which they started to get broken today. Because the other thing that I think that people need, just as trading, need to kind of put together here, yes, a lot of it comes from the news, but a lot of it, people wonder, well, why is it doing that? There's not any news. In fact, the news is not that bad. I was like, well, because they broke down below levels, which is forcing massive adjusting. And that adjusting might be that they better start taking that risk off. Otherwise, they're going to get buried, particularly if we have another drop that takes us back down to the 200 level here in the SMH, or even lower. But right now, 200 level seems to be holding for a little bit of time here. So what I'm looking at here, I'm looking at that if it can hold basically above 240, we got a shot at running back up and maybe getting up closer to 260 before we start to roll over. Now, whether that's due to the fact that we're starting to see some money leave, the SMH and going into the mid caps, yeah, could very well possibly be due to that. But I think quite a bit of it is due to just the way that the flows are moving.
Yeah, because it seems like that valuation, which is at the best level since 2001, small cap versus S&P on both the PE ratio as well as the price to book and the years after that occurred was very positive for the small cap versus large cap. And I've been noticing, you'll see Russell up 3 and the other guys are up 1. Today,
Right.
the other guys are down, Russell's up. I see the financials are up, XLF. I see the healthcare is up, XLU.
Right.
I see the utilities are up, XLV. Or XLV is the health, and the other guy is U
Right.
is the utility.
But I think
So
that
the money
those are
definitely
just
going in there. The money definitely going in there. It's got to come from somewhere. It could come out of money
exactly. I
market.
agree.
It could come out of money
And
market, but it does seem like it's coming out of tech a little bit.
I agree. I do agree with you. And I noticed the same thing today, that they're back into the banks, they're pushing back into the banks, they're pushing back into
Yeah.
some of the selective stocks, and then again into the mid caps. So I see that as well. But
Mid and small, yeah.
but if I'm really just kind of again looking at the charts, and even I'm looking at just on a cyclical basis, all of the XLs, right? So XLU, XLP, XL, all of those sector funds are getting ready for a cycle top, and they'll be. And I believe, if you follow cycles, the cycles are suggesting that they're going to drop, and they should drop pretty precipitously until mid-September, and then rally again. Now, if I'm looking at this in terms of what I would look on an Elliott wave basis, it fits perfectly. We're going to swing back down. We're going to finish a little bit larger fourth wave, or we're going to go up, make new highs in the SPX and new highs in these sector funds, and then just come back down in a little bit larger. So, but for a long time, I've been calling for that we have what I would call a minor degree correction, and it may be complete at that August low that we've already seen. And what we're running in now is a minor fifth wave up to finish an intermediate third wave, and then we get an intermediate fourth wave decline, which brings us back to those same areas that we've just been at. And then we rally again. So, that's about as far as I go with in terms of what the capital flows do, and all of that are shifting around. But I think if I look at that, I'm like, well, they're getting ready to have a turn in the cycle, not a major. So the major cycles are continuing to point up. We have minor cycles that are coming in and need to put in a low before they resume. So again, balancing that out, it just to me seems that we just come back down, but then we rally all over again.
Hey Doc, do you see anything big going on as far as, fading tech and going into those other sectors, or if it is happening, is it sustainable, or is
Well,
it just a little bit of broadening out?
if I look at the semis right now, and if I look at the trends on monthly, weekly, and daily, I don't see any reversal of trends yet. So if there's going to be a reversal into a lower low or a drop sometime this year, it's going to start with a daily chart first, which is going to have to go into a lower high, lower low reversal. That hasn't really even started yet. So that could potentially start as of Thursday after NVIDIA earnings. We'll see if everything's priced into perfection already. But if it drops and then if it bounces into a lower high, that will be, I think, the initial key that might start something like that out. Otherwise, if I just look at this, I see uptrend, uptrend, uptrend across the board with the daily chart just showing a high and tight consolidation at this point. So we'll watch NVIDIA kick things off. I think we're probably going to go sideways into Wednesday, Thursday, and then Thursday is a reaction from that. But to Michael's point, if we don't print a new high on good earnings on NVIDIA on Thursday, so that should pump this thing up past 140 if things are good. And if
Right.
it fails to do that, that will be notable. And that could be
Yeah.
a sell the news moment.
Yeah, that'll be very interesting. Hans, how are you feeling about the idea I was talking about as far as maybe the switch out of the tech stuff and into more of the other sectors that seem to be catching a bid lately?
Yeah, I think it holds for now. I like that idea, and I am also, like everyone else in the world, curious about this, the reaction to NVIDIA's earnings. I feel that the broader market rally can continue either way. I'm sort of seeing, the tech world is waiting for NVIDIA, and I think the numbers should be good. I mean, everyone's saying they're spending tons of money, CapEx through the roof. Anecdotally, I'm hearing from people in the industry saying, look, we cannot get our hands on enough of this stuff. There is no AI winter. It hasn't happened yet. And so the beneficiary, first and foremost, has got to be the picks and shovel makers like NVIDIA. Now, whether anybody can make money from this stuff, that's not NVIDIA's problem. They don't care at this point. They will in the long run because they want people to keep buying this stuff. But
Right.
at this point, they are going to be the direct beneficiary. So I'm not sure how the number can be bad, but we know the market works in mysterious ways, and expectations are what they are, and we'll see depending on whisper numbers and also their commentary as to how they see things going forward. So very interested to know how that affects things. I don't think a negative from NVIDIA. It may initially cause a panic in the overall market because AI has been such a huge thing, kind of supporting this idea that, all boats are floated. But I think the rate cuts are really what the broader market. So when you look at the RSP, when you look at some of these other sectors that the guys are talking about here, the XLUs, you've got consumer discretionary, you've got even energy starting to pop up a little. They don't look great.
Right.
When you look, they look good. They're breaking out, but versus the S&P, they're not yet breakaway. They're not yet, full horse racing out of the barn yet. So there's room for the broader economy to go, and it does not trade very expensive. So I think there's this potential for everyone to kind of focus on NVIDIA and technology, and potentially, and that's what I'm telling clients lately and students. I'm saying, listen, don't forget there's a big, beautiful world out there. Look around. There's all kinds of great stuff happening. I think that the rest of the other 490, if we can ignore the Mag 10 for a moment, the other 490 are going to be taking their cue from lower rates, and that's a very positive. Now, I think the fly in the ointment ultimately, because I try to force myself to always find that fly, it could be that inflation is stoked at some point, right? We can't have everything. We can't have inflation is down, but the economy is fantastic again and things are looking good. At some point, I mean, maybe the porridge is warm for a while, but at some point, maybe we get a bit of that, and then we don't get as many cuts as people had hoped for. And then that kind of brings a little bit of worry back into the situation again.
Yeah, one thing that might add some credence to we might not get as many cuts is that the US dollar index, DXY, has come into what I have is some long-term support neighborhood, just around 100 or a little bit under 100. And so, yeah, you see the gold line right there. So it's now underneath it, but that RSI is dead on its butt. So it's either going to go into the abyss, it looks like to me, or they've sucked everybody into the sell side and they could take it the other way, particularly when they get it back above your gold line there, you know?
Yeah, if you look at the 10-year, so if you look at the 10-year yield, the TNX on the long-term chart, you can see that it can kind of pull back into maybe that 3.4, 3.5 range. And then there's an argument that there's a lot of support there, and if the market bears and the the sort of the rate bulls get what they want, we could see that kind of bounce back, and then it's a whole new ball game, right? Then that's going to be just that'll shake up everything again. So, but the question is, what do you do till then, right? And I see a lot of people who are negative, waiting for a pullback, and I just see things positive. I know September and October tend to be difficult periods, at least the first part of October. The last 2 weeks of September are horrible. Maybe we pulled a lot of that negativity forward in early August. I don't know. But so
Yeah.
we definitely have a few question marks over the next little while, and then the corporate buyback window closes, and then the CTAs are going to rebalance a little bit. And then what? Then the question is, well, what do we do around mid-September? So I feel like maybe we push higher until kind of the first week, end of the first week of September, and then I'm not quite sure at that point.
Yeah, I've been looking at the VIX as well, and that VIX is went down to 14, which I think is or 14 neighborhood, which I think is a very important number. And it's now in that range of 20 to 14. I think if that range were to break, it'd be somewhat significant. Or it might be a deal where it stays in that range for a while. Because if it stays in that range, it does seem like people's confidence in investing is pretty good because of the relative stability of volatility. I don't think when the VIX jumps way above 20, people are very comfortable with putting new money in and that kind of stuff.
Yeah, and I would just add one more thing before I let someone else speak here is to your last point, when things are stable, that brings down realized volatility. So you can almost think of sideways and stable as bullish because the more volatility compresses, the more, if you look at some of the flows that places like Goldman are talking about, the more things kind of stay sideways and realized volatility comes down. And for the listeners, realized volatility just means actual movement, right? So as long as the market is relatively quiet, that builds up the amount of stock to buy across many different strategies. So sideways means you start to kind of push up higher again, just by virtue of that sort of structure of CTA buying, vol target buying, and all those funky things that we tend to look at on the vol trading side.
I wanted to talk a little bit about Bitcoin because there are some people still like Tom Lee who thinks there's going to be a very big explosive move as we go into the end of the year. Since the Fed obviously has thrown the dollar under the bus a little bit, it's possible now. And the Bitcoin and the 50,000 that was hit on August 5th is already in the 60s. So, Michael, let's start out with you and get the Bitcoin deal, and maybe we can put up some of the Bitcoin type stocks like Coin or MSTR or Mara or some of those. But Michael, do you have a view on the Bitcoin here?
I actually don't do analysis on Bitcoin, but my colleague that does the trade room with me, he does. And the thought process is that lower dollar, Bitcoin likes it. And so every time I've noticed that the dollar starts to tick up, they start to come back and knock Bitcoin down. Now the dollar's up off its lows today, and likely will, if it continues to rally, Bitcoin should come out of it already has, but come more significantly out of the red and start to move higher again. I think if I'm just looking at that, it very well could be on just that low at 50,000 was it for right now, and that we do kind of still continue to build on the rally. The next hiccup, of course, or the next challenge is going to be 68,000 to 70,000. I do think that eventually all of that sideways move just appears corrective to me. So I would be looking for more of an impulse, and that impulse should be to the upside. And we might just be in the very beginning of a stronger impulse. But if it fails from here, then we're very likely going to go below 56,000, and we stand a stronger chance that we will dip below 50,000 again before any rally. Now, that's just right off the cuff looking at that chart.
Sure. What are you thinking, Doc, as far as Bitcoin's concerned? My number was 65,000. I'd like it to sustain above that a little bit. Then I think it would take out the 70. What are you thinking?
If I could have Dave go out to a weekly chart or a monthly chart, anything like that on Bitcoin, what I'm looking at here is from the old school charting days. This is a really nice cup with handle setting up on the weekly chart. And so if we take the depth of this cup from the neckline down to the lower in November of 2023, I think we're looking at a potential measured move here of about 120,000 or so. And so to me, I agree with Michael here, is that I think the handle right now is purely corrective. I think it's meant to shake everybody out and basically leave everybody saying, well, this is never going to break out. I quit. I'm going to go into mutual funds or something like that. And that's almost precisely the time that this thing will break out. What I've also noticed with Bitcoin and just about everything else that's crypto related is that it tends not to work well on breakouts. What I find works best with Bitcoin is one step back, two steps forward. So actually working off of a slingshot. So as we get up to maybe 70,000, have this thing drop down one more time and everybody goes, oh, I knew it. This is never going to break out. I quit. And at that point, we may get that catalyst moment that breaks this thing out and gets the run. Similar to what we went through at the beginning of the year into that big impulse move out of the corrective. So I still think ultimately this is a bullish looking chart with a cup with handle. This is nowhere near the type of corrective move that we had back in 2021, which is the beginning of 22, which was absolutely destructive. So to me, this is all corrective and constructive at the same time.
How about we throw a couple of stocks up there, David, like MSTR? This is where the guy borrows money and buys Bitcoin with it. Michael Saylor.
Yes.
Yeah, and he keeps doubling down too. I mean, he just keeps he keeps selling more tranches of this, and I think they're going to be. Did they already split?
Oh yeah, they did. It used to be $1,500.
Okay, yeah. Well, that makes sense then. Yeah, they're going to continue to split this thing.
That's why it makes it a little bit more affordable. And especially if you do call spreads where you buy one call, sell another, you can bring those premiums back down and just play for the strike differential. And what about Coin, COIN, of course, Coinbase? Same story, holding on to that support. You know, this is where there could be some decent upside if these guys are going to be half right on these things, you know? And then, of course, IBIT is the big one for my shares. I think that's back on the bicycle, maybe. I don't know.
Yeah, it
Yeah,
is.
back on the bicycle.
Definitely on the
I
bicycle.
cannot wait for them to list options on this. Hopefully this is going to be by the end of the year.
Yeah. Well, you got options on MSTR and Coin, so if you want to play those two games. What about Hans? Do you have a feeling along this? I mean, are you thinking there could be a big, stupendous move, or you think this is a lot of hot air, or what do you think?
I think it is hot air, but I think hot air balloons can inflate and inflate and inflate. So, I'm a fan from the perspective that I've seen a lot of bubbles inflate in my time, and I think it goes to 100 grand. I mean, why not? There's still no respect for fiat currency. There's, the money printing isn't going to end. Whether it's Democrats or Republicans, it's going to be money spending, and why not? I mean, I've been looking at the miners a little bit lately. They're really, really lagging. I watch CLSK, Mara. CleanSpark is one of the more heavily institutionally followed names. So that's one that I like to look at. And I'm not seeing anybody jump on board, really lagging versus the actual coin at this point. Now, that can happen sometimes. We saw that with gold miners for years. I mean, they can really toss them out the window versus the underlying metal. And maybe that's just a matter of what's happening here. People have gotten burned on them, and so they're slow to get back in. But I think that would be kind of a more interesting way to play a potential breakout. And I do think the breakout's going to happen. So this is the kind of stock I could see at $25 very easily. So, you know, pretty decent risk for it, I think, just given the fact that they've lagged so much.
What's the symbol on Clean Spark?
CLSK.
CLSK.
Yeah, you got it right up there.
Yeah, I couldn't see the symbol CLSK. Hey, listen, you just made a good point, Hans. I'm going to segue right into this thing before I give you guys all individual time. Let's look at the price of gold and then look at price of Newmont Mining, because talk about lagging the field. I mean, this thing used to be $85, went down to $30. Now it's been creeping up. It's in the 50s, but it has a lot of real estate above if it's going to play catch up to a $2,500, $2,600 gold price. So if you look at a long-term graph, because in the short run, it's making, hey, there you go. See, that's the real estate I'm talking about. So is this thing, let's start, give it a round turn. Now, of course, that RSI looks pretty darn high. But Michael, how do you feel about the gold shares here versus, I mean, is the gold going to hold this 25, 2,600, or is that going to come down?
I think gold is going to go much higher.
Okay.
My longer term view on gold, I think, let's just talk about, like, I don't know what the term on this particular chart is, but I think on a daily to a weekly basis that gold should go above 2,600, get a little bit closer to 2,700 before it does anything on a little bit larger scale in terms of a pullback. But I think it's like, and I have levels that there's too many behind the scenes things going on in gold, and we've discussed them. And one of them being, when we've got digitalization of currency going full bore around the globe, and China's on board, and Russia's on board, and India's on board, and the US is actually just not talking about it, but they're doing it. And so when you consider that, what we're back to, if they don't like fiat currency, right, that's going to hell in a handbasket, then what do you got? You better back it with something. And if you have a digital currency, that's like saying, well, gee, what is Bitcoin backed with? So if you're going to have a digital currency that's going to fluctuate and it's all digital, and we don't get anything realistically to hold in our hand to say, well, that has value, then it has to be what they're doing, and that's gold. So we're seeing a lot of gold being bought up in advance of backing these currencies. So I think those are not just buying it for the rally. They're buying it and sticking it in storage because they got to back currency with it. So
Doc, do you have a feeling about the gold shares versus the actual gold price?
Well, to me, Newmont Mining has always been one of my favorites, but it's been a while since I've gone in to see. The problem is that what it costs them to get it out of the ground and bring it to market. So I don't know what their per ounce cost is, and so that will have a big thing. But as gold now really gets itself above 2,500, I would suspect that their out of the ground cost is they're having nothing but revenue.
Yeah.
So I would think that what we're coming into is, I mean, I'm just looking at this chart, and I think, we could break out. Now, according to the RSI is showing that, well, you might get a little pullback first, but I think maybe back to that gold line, but no lower than that blue line, and then we just rally in strength again. But it just depends, because there's so much cost to get gold out of the ground and to refine it and to get it, onto the market. And so that's why quite a few miners sit and do nothing, because it's not to their advantage to go in and mine the gold. It might be now, but then you got all that cost to get things started again and all that other stuff. So to be honest with you, I would expect Newmont to climb a little bit better than it is. I'm not sure when it was getting ready to touch 80, where was gold? And if you just do, just a simple calculation, you'd be like, well, why isn't it even closer to that? I can't imagine that when it was touching 80, that gold maybe was touching 2,400, and now we're
Right,
about
something like that.
2,500, and we're not even we're 50% to that level.
All right, I'm going to let Doc take over the screen, and then Hans take over the screen and explain how some of the things they like a lot, and also, how they go about helping people when they contact them. So, Doc, you want to take over the screen a little bit there and show us some of the stuff you like right now and some of the things that you're going to help people with when they contact you?
Sure thing. Okay, hopefully you can see the screen all right here. Again, I'm looking at the S&P and just looking at this, there's a monthly swing going on here. And we have, if you look at this study, which is the choppiness index, if you look at this as like, this is full energy, this is empty. We're not quite at empty yet. There's still a little bit of gas left in the tank. We got a quarter tank left. And again, I'm thinking that we may get up near 6,000 before before the next round of volatility kicks in, which is going to be similar to this. If you look at things right now, if we kind of scrunch this in, what we're seeing is that as we go further and further up this, we are getting more and more volatility. So this is turning into a broadening pattern. So for those of you out there, buy and hold is going to get to be increasingly more and more difficult to just sort of hold through these pullbacks unless you just, let your brokerage statements come in the mail and you just don't open them. You just leave them alone, right? So I think learning how to trade this, learning when to bail, learning when to buy on this, I think is going to be increasingly important over the next few years, especially if we, as I've heard tonight, as we use more financial tools to sort of kick the can down the road. Right now, just as of today, again, what I'm looking at is we have trend on all different time frames, and we're just consolidating up here and just waiting for this energy. It's close to empty down here, close to empty. So waiting for this to charge back up again. I think we'll make a run for new all-time highs before too long, and that could either be driven by, the combination of things such as NVIDIA earnings. It could be a soft PCE print that comes along on Friday, or maybe we're just going to walk sideways until the next Fed meeting. Not quite sure of that. So what I typically do to help people is to let them understand how to break charts down into like monthly, weekly, daily charts, understand energies, understand price action, and just have a simple approach to the market every day. I'm certainly not an expert on all, 50,000 stocks that are out there. So typically what I do is I focus on the S&P and some of the major indices, and then use different approaches to be able to trade that. So whether we are in corrective or whether we're in quiet and trending or corrective, quiet and trending, corrective, there's different strategies that we can play to take advantage of what is currently working today. So one of the things that's actually working today, and this is what I use for what I consider to be quiet and trending markets, is what I call the cash flow campaign. And so this is a campaign trade. So basically every day I'm just rolling short options in kind of this moving diagonal. And these things work exceptionally well when we have these kind of quiet grinding moves. And so we do have a course that's available. You can get into it for $79 as opposed to the street price of $97 by using the promo code of campaign 79. If you go to 12minutetrading.com website, look for the courses, use that promo code, get into this. This is a masterclass that we have. Learn a lot about time spreads, learn a lot about trading and the ways to make money during this kind of condition. Okay, so with that, back to you, Jim.
Yeah. Okay, so thanks a lot, Doc. Very good. And Hans, could you take over the screen and show us some of the things you're liking, and also how you help people when they contact you?
Hans, you're muted.
gotta send him a little note.
There we go.
Yeah.
Hey guys. So yeah, sorry, I was on mute there. So yeah, just a couple of slides showing everybody a little bit what I'm thinking here. You can see that tech very over kind of owned the rest of the market really broadly underloved. And so, I'm starting to see kind of that, there's a lot of movement into these areas that really benefit from those lower rates. And I think that's kind of somewhere people can kind of focus on a little bit in order to broaden out their horizons a little bit. I see people really focus on the same old thing. And we really saw that with the semiconductors breaking down a few weeks ago, and saw a lot of people sort of pushing into those same trades, selling puts in names that were falling and catching a falling knife. And I think, what I like to see from students is this ability to kind of look around a little bit and go, okay, this isn't working, but this is working. And one of my favorite sayings is, at the end of a successful, option selling campaign, you often have a loss. And that's your signal that, okay, things have changed. There's a transition going on. And so what we do is we try to help people understand where that transition is, because the whole idea of option selling, which is kind of capturing that volatility risk premium, right? What are people paying over and above what an option is worth? Well, that's the VRP. And so that's what we're really doing, in a sense, is we're trying to capture this excess that, Warren Buffett would love to make year after year, and does, in terms of what people are paying for their option premiums and insurance policies. But it's a fantastic strategy, but it needs to be done with a mind towards risk management. And that's really what we're all about at Crush the Premium and Cash Flow Insider. So we have a number of programs that help people with that. So it's really about recognizing when to kind of press down on that gas pedal, and then when to sit on your hands sometimes, right? Sitting on your hands is a position. And I think it's a very, very valid position. And so from my perspective, having been in the options game for 30 years and managed $1 billion in these kinds of funds, I have understood over time that, success in this game is often from putting on good trades, but it's at least as much about avoiding the bad trades and stepping in the big piles of what that are sitting around all over the place. And a few weeks ago was a good example. You start to see charts break down. Well, it's time to get out of the way and start looking at doing things a little bit more differently. So we have something to jump on here. This is a free course, the 4-day options challenge course. And I'll throw that into the chat so that people can just kind of click on it if it's available to folks. And that's going to be 4 days. Every day you're going to get a lesson packed full of value, and some of the strategies that I use, related to the sort of 4 or 5 pillars that I look at: fundamentals and charts and volatility edge and flows, and then putting it all together, figuring out what strikes to use, what duration, what expiries to use. So it's all really this kind of big thing that comes together to make you more of a success at this game. So click on that, sign up today. It's completely free, and hope you get something out of it.
Okay, sounds great. And Michael, please take over the screen and get a little idea on how you're trading things, and also
Okay.
how you're going to help people when they contact you.
I sure will, as soon as my actual screen tells me which one I can share. I think it's going to be, let me put this up first and then give it a try. Now let's go over here, go back inside this thing. All right, so that's going to give a little bit of heartache to get in there and set this screen up. Zoom. Give me 1 second here, guys. Yeah, well, let's try that one and see what we get. And I'm going to bring my screen up to there, but it's not. So I got to stop my share and get to the right share. I'm unable to really get to where I want to be. And there it is. Okay, now we got it. All right. So first of all, this is a chart that I actually just update. I don't, geez. I don't, geez, come on, let's. I'm having trouble getting this all set up, David, because I'm usually much better at it.
What's going on? I see I see your ES chart.
Okay, I want to do that. I want to bring it into full focus. All right. Oh, I know why it is, because I put this up at the top of my screen and I don't want it there, but that's okay. So, let me, yeah, you know what? I'm not able to, but let me just go and talk. I am an ex market maker, an ex options market maker. I've traded here in San Francisco, and I have also traded in Amsterdam. I've traded in London, and most of it here in San Francisco. Now, what I did as a dealer in options, I was the person that stood in the crowd and sold you the calls and bought the puts from you when you were in a bullish mood. And so my view of the market takes a whole different thing. And what I do now is I have a trade room. So in 2013, I shifted and I stopped trading options as a job, so to speak, and went into day trading. And so what I've developed is just being able to move in and out of the market on a day-to-day basis without carrying an overnight position. And what I've now added to all of that, so I do have a trade room, and I run the trade room together with which started out as a coaching client with mine, but learned Elliott Wave and then additional indicators so well that we now do the trade room together. So what I'm providing is a daily update, which just covers what happened during the day and in the S&P and in the NASDAQ. And our primary focus is, again, on the NASDAQ future, on the NQ. But what I've added to my side of the technical analysis is I deal with the flows, and I mentioned that before. And those flows are the capital flows, the money. Where's it going from? And then to. And then also I look at the options flows and how they're trading and what they're trading. And then I also look at the gamma flows. Now the gamma flows, gamma, Hans can be able to tell you all about it, and all of us would, but gamma flows take a little bit different seat at the table. And they're very, very important because what develops is there are levels. And like I mentioned before, risk on, risk off trades. So we've just now going through, and if they don't bring this down and break a level in the S&P, then we will. Then I do believe we'll go to new highs because the risk on trade will carry through and they will just keep doing it. And what that risk on trade is, folks, they're selling the VIX. The VIX is a cash market. So when you short the VIX, you're getting money. And then they take that cash and they then start, and what they're doing is they're buying the underlying volatility within the SPX or the NQ. Quite lately, it's been all in the Mag 7, NVIDIA, Apple, Google, Amazon, Broadcom, like it's Tesla. And so those levels get put out and produced every day, and you have different collections of gamma. And so again, if you're looking at something that's above the market and it's getting up close to it, that gamma level should provide resistance. If it's broken strongly, what's going to happen? Well, all those shorts that were there are forced to cover or forced to adjust. And if not, then the higher the market goes, the shorter whoever is holding that position gets. And the same thing on the downside. When a level on the downside gets broken, which is signaling risk off. So we have volatility triggers. We have call walls, put walls. We have different levels of gamma collections, where gamma collection is notable. And when they start to break down, and when a volatility trigger gets triggered, depending on the direction. So if it's on the upside, it's going to trigger the risk on trade. To the downside, it's going to trigger the risk off trade. Now, and again, that starts to move us into what I mentioned before, a negative or a positive gamma atmosphere. We are still in a positive gamma atmosphere. Do not be fooled, even with this downside. We are still in a positive gamma atmosphere. We would have to break below 5,600, and I'll tell you, in the S&P, it's 5,550. That would have to break to kind of toss the cookies over to risk off. And because you'd be looking at a much larger correction, but it may not take us back below 5,000. I mean, that could be the floor, which it has been for a long time. So that's kind of what I do. Now, what I would offer people, daily insight as to where you're going to want to trade and how you're going to trade it in the options. So we got the spiders, we got the Qs, we got the SPX, we got the ES, we got the NQ, then all of the auxiliary ETFs. So, and that's we get all those numbers put together, and that's what I put out so that people are able to trade. And it's only given, I only give that information within the trade room.
Okay, sounds great. David, I think we're pretty much at the top of the hour here. As far as Option Professor is concerned, do you want to spend a moment or two, or you want me to just explain how they can get my information?
Yeah, if you want to just go ahead and talk about it for a few minutes.
Okay, yeah, sure. The Option Professor has a couple of things going. We've got two things we do for people. We educate them with the Options Masterclass. This is 3 sessions and 6 hours of material. So obviously it's very, very comprehensive, and myself and Daniel Sidnick put it together. And it comes free of charge when you subscribe to the Options Alert service, which comes out every Sunday night. And basically in that service, I identify strangles. Those are calls and puts on individual stocks that I think are going to be very, very volatile. And we're very happy with how things are going with those because, as you know, the volatility has been tremendous on many stocks. So that's a good thing. But we are very selective on what we come up with for ideas. So you get the masterclass to educate yourself. You get ideas to consider and learn a little bit more about how trading works. And we find that to be a pretty good deal. So that starts out, it normally is $197 a month, and we cut $100 off for newest subscribers. So for $97, you can get the masterclass to keep and try out the service for a month-to-month situation. Optionprofessor.com, OPTION professor.com, or shoot me an email at optionprofessor@gmail.com, and I'll respond to it and give you any more information that you need. Thank you very much for being here, everybody. Always good to talk to Hans, Michael, and Doc, and a lot of stuff coming up. I got a long weekend, so let's enjoy that. But as soon as we come back, we've got all kinds of information. So check out what these guys can do for you. And again, until we talk again, David, I'm going to come back to you.
All right, thanks, guys. Excellent analysis for a great 10th anniversary episode of Crowd Forecast News. So just a quick update on what's coming up soon. Mark your calendar for September 10th, 11th, and 12th. That will be our annual Synergy Traders Fibonacci and Elliott Wave event. So we're getting ready for that. It's always a lot of good info on that series. And then, of course, just want to remind you that be sure to subscribe to Timing Research on YouTube and your favorite podcast app, and also Substack now is available. And the full 10-year history of the Timing Research events and presentations and everything are always available on the Timing Research YouTube channel for you to review at any time. So just want to thank my guests again for today. Doc Severson of 12minutetrading.com and Michael Filighera of logicalsignals.com and tradershelpingtraders.com and Hans Albrecht of crushthepremium.com and the Option Professor of optionprofessor.com. Thanks, everyone.
Thanks, David.
Thanks, guys.
Thanks, David. Everybody else, thanks.
Okay, bye-bye.